In this presentation, we're going to record a sales receipt or receive payment type of form. In other words, we're going to have a transaction imagining we're going to make a sale within the shop. We're going to be selling a guitar within the shop, and therefore we'll be receiving payment at the point in time that we will be providing the goods, and we'll be using then not an invoice, but rather a sales receipt type of form in order to record it. Let's zoom into it with Xero. Here we are in our Get Great Guitars dashboard. Let's go ahead and open up our financial statements. We're going to open up the balance sheet and income statement this time, since this is kind of like a new form that we've done in our practice problem. Open up the balance sheet first. When that opens up, we're going to duplicate the tab by going up to the tab up top, right-clicking on it, duplicating that tab. That'll bring it to the right. We're going to go back on over to the left, do the same thing for the income statement. Selecting the accounting drop-down, we're going to go on down to that income statement. As that opens up, or when it opens up, we're going to go up to the tab up top, right-click on that tab, duplicate that tab. Then I'm going to go back over to the balance sheet. Going to change the date. Want to make the date for the 2020. So I'm going to bring this up to January 31st, 2020. Let's update that form. Now I'm going to take the opportunity down here to go look at our flowchart in QuickBooks Desktop just to consider the flowchart. Within our flowchart, we're in the customers section. Last time we talked about invoicing. So invoicing is going to happen when we do the work. Often happens when we have something like a service type of company, like a billing company for law services or something like that. But it could be in terms of goods as well. We created guitars and shipped the guitars out and expect to get payment later in the mail. That's the invoice here. Now we can imagine, well, what would happen if we sold the guitar in the store? You can imagine basically having the cash register up top, someone coming up, paying you cash, giving them the guitar at that point in time. Well, then you wouldn't be using an invoice, but something like a create sales receipt. That's what we're going to be talking about here. Basically a create sales receipt type of document for the recording of the cash at the point in time, or whatever we receive in form of payment at the point of time the service or goods are done. So these two forms are going to be very similar. However, the big difference will be this one will be increasing accounts receivable, whereas this one will not. It'll be increasing some form of cash account. Now we have the same kind of issue. Notice that these two forms then get to the same point in time as this one in the flowchart, because this one basically is like an invoice, then we'd receive payment on it, then we'd be at the same point. Now we have at this point, just like the receive payment, a decision as to whether we want to make the sale, put it directly into the bank account at that time, or put it into that kind of clearing account and then go to the bank so that we can group the deposits in the same format in the bank account in our system as they will be seen on the bank statement. This is probably a bigger problem for people that create more sales receipts, because if you imagine that we have the cash register in the store, we might be getting all different kinds of payment, right? We might be getting cash, other kinds of, credit cards and other kinds of payment, possibly checks and whatnot. We're going to have to combine all that stuff together and somehow go to the bank with it and deposit it. So it's less likely that we're going to have then, if we sell a lot of sales in a day, a situation where we can kind of group those sales together as we make the sales in a similar way that they will appear on the bank statement. We're probably going to have to take all that cash or whatever we have from the drawer and then go over to the bank and deposit it. And we want that deposit to appear on the bank statement in the same format that it does in our books. And therefore, we would need that kind of clearing account to do so. So we're going to use that same kind of clearing account method as we enter the sales receipts. So here we have it. We've got our balance sheet. What do we expect to happen when we do this? We're going to create a sales receipt. And this is what I would practice doing every time you think about putting in a data input. Look at the financial statements or the trial balance, see what's going to happen, then do it and think about what's going to happen. And then once it's done, see that it did happen what you thought was going to happen. So we're going to have a sales receipt, which is going to increase not the receivable, but the checking account or the cash account, which I'm going to put into the undeposited one, the clearing account first. The other side's going to be going to, just like the rest of it's kind of like the invoice, right? This is the one piece that's different. Then it's going to be going to the income statement, and the income is going to be going up here, but only by the sales amount, not including the sales tax. The difference, if we're selling goods for the United States, is going to be going to the payable account for the government taking out the sales tax. Then if we're selling inventory, we also have the inventory assets should be going down on the balance sheet side of things, and on the income statement side of things, the cost of the inventory, cost of goods sold, the expense of the inventory should be going up. Let's take a look at that. Let's go back to the first tab. and I'm going to go to the plus button up top, and we're going to go down to the receive money. So it's going to be the receive money form, and you can call this kind of like a sales receipt type of document, but we can use the same form for other types of received payments. Now, I'm not going to put it into the checking account directly. I'm going to put it into the clearing account, and so that we can group them together and then put them into the checking account in that one lump sum. So here we have it. We're going to say that we're imagining that someone's coming up in our store and buying a guitar. We're going to say the customer's name is String Music. String Music. It's a new customer, so we're going to add the customer. Going to put this on the date. Let's put this as of the 13th. So I'm going to put this as of the 13th. Let's make it the 14th. 14th. And then we're going to go on down to the item. So imagine the String Music representative came up and they bought an Epiphone semi-hollow body. So an Epiphone semi-hollow body. So I can say, yeah, that's a good one. That's a nice guitar. Let's see if we can find that in our drop down here, which apparently I'm having a little trouble with. It's an Epiphone, oh, there it is, the Epiphone semi-hollow body. And we have quantity 1 of those. The cost is going to be $400. There will be sales tax of the 9.5% and $400. So there we have it. And that populates for us just as easy as the invoice. We can imagine someone at the front of the store checking this out, not having a problem, just simply checking out this item, not needing to know how to set up this item or what this item means, not needing to know what happens to the financial statements, just simply populating this and saying, yeah, you owe us $438. So then we're going to go down here, and what's going to happen, let's think about the financial transaction again. The cash account and the clearing account is going to go up by that $438. Then the other side, that's what it means to have a receive money as opposed to the invoice when we're doing the full transaction. We're imagining a sale happening in the store. The other side is going to be going to income, but it only goes up by the $400, the amount we get to keep. The difference, 38, is going to the state, going to go to a liability account for sales tax payable. We also have the inventory going down because we're selling inventory, which we're tracking in the system by some amount that's not on this form, but is being driven by this form. It knows what to go down by given the fact that we have the item in place. That's what's going to drive that. The other side, the cost of goods sold expense related to us consuming the inventory to help generate revenue, will go up on the income statement side, bringing the net income down. Let's check it out. Let's go ahead and save this. Then we'll go on over to the balance sheet and see what happens to it. We're going to update this report before we do so. So it's got the current data. We only work with the fresh report down here. We're going to go down to the clearing account. So let's open up that clearing account. So this one should be going up for the receive of payment. So if we scroll down here, we see then String Music, the receive money, and there's the $438. That's for the full amount, including sales tax. If I then go back to our report, the other side's going to be on the income statement. Go into the income statement. Then here's our merchandising account. I'm going to refresh this one. Let's update it. Update it. They like to use the term update. The date has been updated. And then we're going to go into the merchandise, which is our income account, our revenue account, our sales account for inventory. And then if I go back down, we see that we have this String Music, the $400. That's the sales amount, not including the sales tax. The difference between those two being the sales tax. That's going to be back on the balance sheet. So let's go back to the income statement here and then go to the balance sheet tab and see the difference there, which is going to be in a liability account because we owe it to the state under sales tax for the 113. If we go into that 113, we will see the amount for the sales tax. It's good to get used to the forms that are in these accounts too. And the sales tax form, you should always see the receive invoice and the receive money, which are going to be increasing the sales tax. And then of course we'll pay the sales tax at some point. Then I'm going to go back to the balance sheet. The other thing that's going to be affected is of course the inventory. If we're tracking inventory because we sold inventory, our inventory being the guitars, and that's what we sold. So if we go back up top and we go to the inventory asset account, then you would think that it should be going down for String Music for that the Epiphone semi-hollow body that we gave to them. So if we go on, we see the string music and the 320. Now that 320 isn't going to be actually on the form that we made out. So here's the receive money. It's not on this form, but it's driven by this form, by the inventory item that has been set up. Going back to the balance sheet and then going over to the income statement, the other side is going to be in the cost of goods sold. So the cost of goods sold then is going to be here. And if we drill down on the cost of goods sold or zoom into it, whatever they want to call it here, we're going to go into the detail for it. Then we'll see it should be going up, the expense. So here's the expense going up by that 320, bringing net income down. So the net effect on the net income for the income statement is that the merchandise income went up by the sales amount. Here, the cost of goods sold went up for the cost of the guitar that we sold, and then the difference is the net increase in the net income. We could also go and look at the supporting account, which would be for the inventory. I won't do it here. It's the same as for the as when we did it for the invoice. So we have the inventory. We can take a look at the supporting detail to see how many guitars we have left, what the cost of them are. We should then come to the same number here of that 1944 in terms of the cost.